Welcome everyone to this webinar where we will discuss tax incentives and what a global minimum tax means for developing countries. My name is Nathalie Bernasconi and I am the Executive Director of IISD Europe and lead IISD's work on economic law and policy. This month, the G7 reached a historic deal to introduce a global minimum corporate tax rate of at least 15% to try to stop tax competition. Pressure is on other countries now to follow suit, including at a meeting of the G20 at the end of the month and the OECD G20 inclusive framework process in early July. Ahead of these upcoming meetings, we wanted to bring the tax, the trade, and the investment communities together to discuss what a global minimum corporate tax could mean for developing countries, transnational investment flows, and resource mobilization for sustainable development. At IISD, we have been working on rethinking and redesigning international investment regimes to advance sustainable development. We are working with developing countries, integrating economic, environmental, and social sustainability into investment treaties, contracts, and laws. Developing countries are in great need of investment. Investment agencies place a lot of effort into attracting foreign capital where domestic capital is scarce. Often, countries include tax incentives and exemptions in domestic laws and investor-state contracts, and sometimes even in investment treaties. At the same time, tax agencies are doing what they can to take action against tax avoidance. This is particularly complex in the context of multinational enterprises, where complex corporate structures are designed to minimize taxes. To tackle tax avoidance, policymakers have developed a global strategy to address base erosion and profit shifting. And much of the focus of this strategy centers around transparency and tax rules. It is in this context that a group of around 135 countries, otherwise known as the Inclusive Framework, is discussing a minimum global tax. Under this system, the global profits would be taxed at a certain level so that it would no longer be possible to avoid taxes by shifting profits to a tax haven, since another jurisdiction would collect the tax to achieve the global minimum level. This global minimum tax will be the starting point of our discussion today. What would such a global minimum tax mean for developing countries, and how should such a global minimum tax agreement be designed to benefit them? For example, what would such a regime mean for tax stabilization provisions that countries have agreed to in contracts? And how could related arbitration risks be addressed? If we want to ensure optimal outcomes, international tax and investment policy need to go hand in hand and be coherent. We hope to contribute to this in this debate today and alert investment officials to ongoing international tax efforts and vice versa. I have the pleasure now of introducing our moderator today, Ms. Ali Readhead. Ali leads the Tax and Extractives work for the Intergovernmental Forum on Mining, Minerals and Metals and Sustainable Development. This forum is a partnership of 77 countries and is hosted by IISD. Ali, the floor is yours. Thank you very much.
Thanks very much, Nathalie. Thanks for joining us. Hello, everyone. Welcome to our webinar today. We're really delighted to have so many of you join us from very different parts of the world. So thank you for making time, and we're looking forward to an interesting discussion today. So my role as moderator is to briefly set the stage for the discussion today, to share with those of you who are perhaps less familiar with the reforms, the fundamentals of global minimum tax as has been proposed by the OECD Inclusive Framework. And then I'm delighted to welcome a very esteemed panel of speakers who I will introduce shortly. Feel free to write questions and comments in the chat. As is normal, I think for webinars of this size, we won't be able for people to unmute themselves and speak directly, but please do post your comments and questions in the chat, and we will have two Q&A intervals as we go through the webinar. So please do feel free to make your comments there. So, David, if we can move to the first slide, thank you. So over the last 40 years, we've seen average corporate tax rates decline in every decade in every region. This race to the bottom, where countries compete by lowering their corporate tax rates, has made many countries poorer than they would have otherwise been and led to the rising inequality that we see in the world today. Developed and developing countries have agreed that this must stop. With sustainable development goals to meet and COVID to pay for, they can no longer afford to forego the vital tax revenues to multinational corporations. Moving to the next slide. The OECD G20 Inclusive Framework, made up of 135 countries, have proposed a global minimum tax on corporate profits, otherwise known as Pillar 2 or the Globe Rules. So this tax would mean that the global profits of multinational corporations with an annual turnover in excess of 750 million euros would be taxed at least at a minimum effective tax rate. The effective tax rate is calculated annually on a country-by-country basis. So this means that each entity that is part of a multinational group must pay at least the globally agreed rate in the jurisdiction where they're based. The effective tax rate is the total taxes on corporate profits paid to government authorities. So that is the cash tax paid each year in whichever jurisdiction the entity is based, divided by the company's accounting profits for that year. Moving to the next slide. So what happens if an entity's effective tax rate is lower than this globally agreed minimum rate? So in this first example, you can see that the subsidiary's rate in country B is below the agreed rate. So here we assume that the agreed rate is 15%, which is the rate that was agreed to by the G7 2 weeks ago. So we assume that the global minimum rate is 15%. So you can see in this example, the subsidiary's rate is below the agreed rate, which means in this case that country A, where the parent company is located, will collect the difference between the subsidiary's effective tax rate and the global minimum rate. So this will result in a transfer of tax revenue from country B, where the subsidiary company is, to country A, where its parent is. In the next example, on the following slide, the subsidiary pays the parent company for a service. So let's assume that the parent company provides management services to the subsidiary in country B. So a subsidiary in country B is paying the parent for providing that service. However, the parent's effective tax rate in this case is lower than the agreed minimum rate. In this instance, country B, where the subsidiary is located, is entitled to charge top-up tax on the undertaxed payment to the parent in country A. So this would result in a transfer of tax revenue from country A, where the parent is, to country B. So overall, priority is given to the first rule that I showed in the previous example, the income inclusion rule. So priority is given to the first rule, which would allow the residence country where the parent is located to tax undertaxed profits. The host country measures, like this second example here, the undertaxed payments rule, would only be a fallback. There is one further rule. This is called the subject to tax rule. And this rule is such that, thanks, Devin, countries where subsidiaries are located, so for example, in country B, will be able to charge a top-up tax on high-risk payments to related parties that are taxed at below the minimum rate. So this rule essentially will identify a range of transactions between related parties that are considered high risk. For example, interest payments on related party loans, payments for royalties for intangibles, high-risk transactions, and where the transaction is with a related entity that is taxed at below the minimum tax rate. In that case, the country where the subsidiary is will also be entitled to charge top-up tax. This rule, however, will require changes to treaties, tax treaties, so it's a treaty-based rule. So moving to the next slide, as many of you will have heard, 2 weeks ago, the G7 agreed to a minimum tax rate of at least 15%. And we say at least because I think many of us are hopeful that in the meetings that will be held next week amongst the G20 in the inclusive framework, there's the potential to increase that rate even higher. So at this stage, the G7 has agreed to a minimum rate of 15%. However, a lot remains to be determined in the meetings next week amongst the G20 and the inclusive framework, and certainly beyond that as well in terms of the details around the design. However, it is a significant step forward to have some level of global agreement on a global minimum tax on corporate profits. There's many issues that need to be ironed out, and that's what we're here to discuss today. So I'm delighted now to be able to introduce our speakers on the following slide. So I'm joined by, well, let me go from the order that you have on the screen in front of you, by my colleague Thomas Lassourd, who's our Senior Policy Advisor on Tax and Extractives at the Intergovernmental Forum on Mining, as well as IISD. So Thomas is joining us from New York. Ricardo Martner, who is a commissioner at the Independent Commission for the Reform of International Corporate Taxation. Prior to joining ICRICT, he was the Chief of Fiscal Affairs for the Economic Commission for Latin America and the Caribbean. Thanks for joining us, Ricardo. Then followed by Mr. Anthony Munanda, who's the Technical Advisor on International Taxation for the African Tax Administration Forum. And prior to joining ATAF, Anthony was the Acting Manager in the International Tax Office at the Kenyan Revenue Authority. And last but by no means least, Joy Ndubai, who's with the Institute for Austrian and International Tax Law. And prior to joining the Institute, Joy has worked for a number of non-governmental organizations as well as the private sector. So we're delighted to have Joy with us. So thank you very much, everyone. Now we're going to turn it over to our speakers so we can remove the slides. Thanks very much, David. So our first question goes to Anthony from ATAF. Anthony, welcome. And the question to Anthony is, what will a global minimum tax mean for developing countries? And is it worth it for them? Thanks, Anthony.
Thank you very much, Alexandra, for the introduction. And once more, thank you very much for inviting ATAF for this important webinar. I think it's a very important question to be dealing with at this time, but I think it's also good to start with the caveat that a lot has not been agreed upon. So we are just basically discussing items which have been proposed and out there in the media. But I think it's good also to welcome some of these kind of negotiations and discussions because the world has been waiting for this for a long time. So I think generally we would say that a global minimum tax would help in limiting or reducing race to the bottom. I think that is the main principle under which this discussion is taking place, particularly under Pillar 2. So what does that mean to most of policymakers, particularly in trade and investment and also policymakers? I think that would be a shift in what you'd want to tag, what you want to put in your country to attract investment. So typically you are focusing on having tax incentives as the main driver of attracting FDI, but now because of this framework, perhaps you want to attract investors based on maybe the level of innovation, maybe having a well-established labor force amongst other factors. So tax incentives will be slightly not a priority. And why that is the case is because of the design of the rules, which Alexandra has gone through those rules. And I'll also go slightly into those rules, trying to show possibilities which governments and also MNEs will have maybe to live with, to change along those possibilities if those rules are finally agreed upon. So I think generally there might be increase in tax revenues, maybe in a number of developing countries. And I say generally because there are so many other moving parts along the way. And that generality will arise because of a range of possibilities. One possibility you might see, of course, tax incentives being redesigned. They may be redesigned because of governments now being inspired not to give the tax incentives, or if they give, they'll be redesigned and the rate of tax might be pegged up to the minimum rate. And the reason why that is the case, if you don't do that as a government, then it means that a rule which Alexandra explained called income inclusion rule could potentially crystallize. Now, once that rule crystallizes, what that means is that actually you'll be shifting your taxing rights to another jurisdiction. So let's put an example there. So let's assume you give a tax incentive where the rates effectively for the companies is going to be 5% and your maybe normal rate is 30%. And then we say the minimum rate remains at the G7 proposal of 15%, then it would mean that the income inclusion rule will apply in the sense that the company which is enjoying the incentive first will be seen as lowly taxed because it taxed at 5%, but the minimum rate is as 15%. So the parent company of that company in the tax incentive will take, of course, the income which is actually sourced in your jurisdiction, and that income will be put in the tax return of the parent jurisdiction. So the parent may be in another, of course, maybe a developed market, and then they will tax that income up to the top up to the minimum rate. So they'll adjust from 5 up to 15, meaning they have an incremental rate of 10%. So that will be taxed in your jurisdiction, in another jurisdiction. So the question to the policymakers, would you accept that? Maybe in the long run, maybe in the short run, you might experience challenges to adjust, but in the long run, we'll see a possibility of tax incentives being redesigned so that at least the minimum rate goes, the rate of tax goes to the minimum rate. Now, the other possibility now is where you have preferential rates, preferential regimes outside your jurisdiction being adjusted. So you have a possibility, you are maybe in a market, say in Africa, but you have maybe companies who are members of a group trading with another part of the world where there are preferential regimes. So what has been happening for a long time is that MNEs will take advantage of those regimes to shift profits from the source countries to those regimes where there is no tax. Now, because of the minimum rates, then potentially those regimes will also adjust their rates to avoid triggering the income inclusion rule. And also even more possibility is another rule called under tax payment rule. So let's give an example. From a source country, say in one of the developing countries, a royalty payment is made by your own taxpayer, no more taxpayer, but then it goes to a preferential regime where there is no tax or tax is very low. So an under tax payment rule works in allowing the jurisdiction where the payment has come from to tax it by adding it back. So it denies a deduction or makes an adjustment up to the minimum rate again. So now jurisdictions who will be faced with some of their incomes of a taxpayer being taxed back may also adjust, and that acts as a protection. But there's something Alexandra said that the under tax payment rule will only work if there is no income inclusion rule. So where that income went, if there was no parent company in another jurisdiction where the income would be taxed, that's the only time your source country would be taxed. So in summary, those rules would work together, and you can see how they will affect the behavior of the government, potentially be maybe I don't want to use compelled, but influenced to see the merit of adjusting the change, the rates, and also maybe MNEs themselves realizing that wherever you tax the income, it will be taxed anyway up to the minimum rate. So it adjusts the behavior of both the MNEs and the government. However, having said that, we also realize that there are so many moving parts, and many, of course, countries who are members of inclusive framework have raised concern, and as ourselves as ATAF, we have raised concern in a number of areas. So just briefly to touch on those, these rules will need also to recognize that rate needs to be negotiated slightly at a much higher rate so that you discourage MNEs, of course, from shifting profits. Why we are saying that, if you look at the African landscape, the CIT rates range between 25 to 35%. So if the minimum rate is quite lower than that percentage, then it means MNEs still have an incentive to shift profits elsewhere. So the closer that rate is set, if that rate is set very close to the range of those rates I've talked about, then you discourage, of course, the shifting of profits. So we have, of course, proposed inclusive framework members to advocate for rates of at least 20%. Of course, the other thing is about the priority rule, income inclusion rule. So we have the view that the way the rule design is, if you prioritize a resident-based route, then you are benefiting more of the resident states rather than, of course, the source states. So that is for inclusive framework members who are included here, of course, to negotiate, because that is really at the time of negotiation for better bargain amongst those things. And the last point I want to make is on the subject to tax rule. Those first rules are basically the globe rules, but the subject to tax protects the other aspects of the treaty. So again, as part of the policymakers, we also try to have nice treaties over time, so that, of course, that incentivizes the multinationals to invest in our countries, whether it's a good treaty network. But often some of those treaties are very low rates. And of course, this discussion at this time is trying to fill those gaps, give an opportunity. In case the treaty rates are very low, then a subject to tax will give an opportunity for source country to tax back if the income is not taxed up to a minimum tax rate in the other jurisdiction. So again, there's another global rate for subject to tax rates to be agreed upon in relation to that. And then obviously for subject to tax, there are a range of other things to be considered for it to be beneficial to source countries. Most important thing of those is that that subject to tax rule needs to be made mandatory, implemented in a multilateral system. And of course, lastly, needs to incorporate a range of other payments, not just interest and royalty. So there are many specificities around that. Maybe I'll not discuss those for this at this point. But generally, I would say that there will be a shift, and it's important for policymakers to be aware of this shift, and of course, to pay attention to the discussion which will be taking place on 1st July, and I think at 30th of June and 1st of July, where most of these things might be finally agreed upon. I think at that point, we'll be more confident to say this is the direction, because a number of parts may be settled at that point. So I think I'll stop there and wait for any question. Thank you.
Thanks very much, Anthony. Appreciate that. Very comprehensive. For our non-tax experts who hope that you're following along, if your head's swimming now with all the different rules, that's okay, that's normal. Those of us that work in tax all the time, our heads are still swimming and still trying to make our way through the volumes of documents on this topic. So it's not a simple one, but I think the key point from Anthony there is that there's a lot that's still to be worked out. Nothing's done until it's done. Overall, it's beneficial. Well, as you said, generally, a number of countries will benefit and see increased tax revenues as a result of this, and that it will have some impact on countries in terms of the relevance of tax incentives, the effectiveness of tax incentives, and then also equally on corporate behaviour. So thanks, Anthony. In the interest of time, I might move on to Ricardo. So Ricardo, thank you again for joining us from Chile and bringing your perspective, not only as someone involved in tax, but as someone trained as an economist, having worked as an economist for many years. So thank you. And my question for you is, how will a global minimum tax affect the use of tax incentives in developing countries? So Anthony's given us a nice introduction to that, but if you can take us a bit deeper on what you think this means for the use of tax incentives in developing countries.
Okay, thank you for the invitation. I'm very glad to be here. and to listen to very good introductory notes. I think it's very clear that this is a step to a fair world. But in ICRICT, we are sure that this 15% is not enough. You know, we're trying to push to 21%, as the initial position was, and at the same time, it's a conversation within developed countries. You know, we still have to wait to the position of developing countries here. Since many of them have much more than 50% of corporate tax. Of course, the devil is in the details, you know, tax exemptions, global incentives that make a different reality. For instance, in many countries in Latin America, the effective tax rate is far below the statutory tax. We are talking about maybe 10% instead of the average of 25% of what has been legislated. So there's a big hole there, which is not easy to fill. There's the question of course of tax incentive, but also avoidance and dilution. So what are we talking about? Are we talking about effective tax rates? And then the discussion is very different. I've not seen that has been a point for the moment in the discussions, but I think it's really relevant. Can we estimate the effective tax rates? That will be for the development countries a very important question, and it deals with of course transparency. The second point is that here in ICRICT we don't believe much in taxes to attract in tax holidays to attract investment, foreign investment. I mean, the World Bank, the IMF, many organizations tend to show that there's no direct link between tax holidays and investment. Maybe UNCTAD has a different position, at least some years ago, but I think that's a global consensus that taxes are not the only variable that multinationals take to invest in developing countries. This is true for countries that have, as Keynes would say, a state of expectations as the main driver of investment. That would mean infrastructure, I don't know, human capital, etc., instead of taxes. But so the question is that the race to the bottom is completely useless, and that's I think it's very important to have the same diagnosis for our I don't know consensus between within the inclusive framework. For that point, I think that also, well, some economists can say, or they say that if countries don't have infrastructure or don't have a good state of expectations, then the tax holidays would be a reasonable policy. You know, it's the reverse of the argument. But anyway, in the case of our region, the minimum taxes has not been so discussed since, as I said, the effective, I mean the statutory taxes, as you showed in the slides, are still very high, so much higher than the 50%. How to deal with the transparency part, I think it's the most important. And at the same time, even if the collection of revenues from the long-term effects of the minimum tax rate will be very, very, very low in our countries, since there's a digital gap and the profits, except for the very big countries in the region, are not very significant. No, that's a good, I think it's a point. Many small countries are saying that for them the minimum tax rate is not fair because the question of scale, and that's a point to discuss. I think also within the inclusive framework. Yeah, and finally, I'd like to talk about royalties, since we are here in a forum of mining. We are in Chile. We are discussing, you know, that we are maybe the main producer of copper. A royalty much more higher, and depending on the price of the copper. The state, or the, you know, we will have elections this year, so many economists are talking about $6 billion of additional collection with the boom of the price of copper. So the discussion is much centered in that kind of new ways to collect taxes, and not about tax incentives. All the contrary, the royalties are now the discussion here. So there's a change also of the kind of discussion that is taking place. You're very right to place the end of tax incentives as a political question, since in the 80s it was so normal, you know, and the stabilization of tax rates, etc. But now the winds are changing.
Thanks very much, Ricardo. Great note to finish on. I appreciate your comments. And it's interesting hearing, as you say, in Chile, the focus there is on how to increase taxes on production or taxes on revenue like royalties, rather than providing tax incentives. You know, yeah. So that's quite a shift, I think, and probably indicative of what's going on more broadly underpinning this move towards a global minimum tax, is to try and shore up revenue collection in light of COVID and other financial pressures. So I have a couple of questions at this point that have come through from people on the chat. So just to everyone on that's with us today, I have taken note of all your questions. If I don't ask them now, it's because I've saved them for Thomas and Joy, because I know roughly what they're going to speak on. So we will come to them. But Anthony, I'd like to ask you sort of two questions. The first question was, with respect to the income inclusion rule, what happens if the parent company isn't resident in a capital exporting or developed country, but in a tax haven? So where the effective tax rate is kept artificially low, below the threshold. So what happens if the parent is in a tax haven? How does the income inclusion rule operate? And I think as a sort of sub question to that, is this the end of tax havens? And then the second substantive question is, again, with respect to the income inclusion rule, what's the basis for taxing it in another jurisdiction and not in the source country? So what's the basis for the transfer of tax revenue going from the source country to the residence country in relation to the income inclusion rule? Thanks.
Sorry, could you repeat the last question? Question.
So what is the basis? So with respect to the income inclusion rule, why is it that the top-up tax is being paid to another jurisdiction and not in the source jurisdiction?
Okay, all right.
Yeah. Thanks.
Right. Thank you for those questions. So that's with the last one. I think that's a design question. So it's an important question. Whoever has raised that, also to reflect it as part of the question, maybe from the country. I'm assuming you're also inclusive framework country. So you heard me say that currently there is a order of the rules. So you apply the income inclusion rule first. If the income inclusion rule is not applicable for some reason, then you go to under tax payment rule. so that under tax payment rule comes secondary. So many of the IF members have raised concern on that order, particularly developing countries. And therefore, I would encourage the participants who have asked that question, of course, to maybe use the current negotiation framework, of course, to ask why that order. When we asked that order is the ATAF, the discussion was that the income inclusion rule is extremely complex. To some extent, you can get the sense where, of course, the OECD secretary is coming from, having looked at the landscape in the multinational enterprise, how the consolidation of accounts takes place and how the design of Pillar 2 takes place. I mean, how it's currently being developed. So there could be complexity. I use the word could be. And therefore, that's the reason why they viewed that income inclusion rule is perhaps easier. Reason being is so much designed closely to what we have as CFC rules. So there's a lot of borrowing on existing regimes on how to implement the income inclusion rule. So that perhaps would have inspired. But having said that, we still hold the view that a better way of looking at these rules was to prioritize, of course, source countries where these base eroding payments are coming from, and you allocate, of course, the tax to those countries. But of course, it's the country decision at this time. I think I want really to say that because we are at the point of negotiation. So the next question was about whether this is the end of tax havens. I think Ricardo raised that question indirectly. It's a sensitive matter because indeed it will put pressure on those jurisdictions where there is no tax. And of course, a number of them are saying this is not a good outcome because they don't have large masses, they don't have economies where they can attract investment perhaps in a different way. Therefore, having this minimum tax would be a problem to them. So again, they might also negotiate for these rates to be changed, or maybe another framework to be developed to help those countries to fill the gaps they might experience, because truly they will experience a reallocation of their taxing rights to many other jurisdictions. Then related to that question is what happens if the parent jurisdiction is in the tax haven and there is an income inclusion rule. I think based on the design of the income inclusion rule is contemplated that the income inclusion rule will be taken over by the parent. And if the parent obviously is in a low tax jurisdiction, then other rules will have to apply to fill the gap. So possibility would be the under tax payment rule would apply in those circumstances. But it's very, in most cases, you'll find that the ultimate parent jurisdiction will be outside low tax jurisdiction, but his subsidiaries will be in those jurisdictions. So there will be only those exceptional circumstances that will be the case, but then the under tax payment rule is supposed to fill that gap, where now the income will be taxed back in the source jurisdictions. Yeah.
Thanks very much, Anthony. Appreciate your responses. Ricardo, two questions for you, if you're there. So you mentioned, you raised the issue of the rate, and you're concerned that the rate that's being floated at the moment of 15% is too low, or is much lower than the statutory rate in many developing countries. So my question is, are you concerned that this global minimum tax rate then becomes a cap on corporate income tax, or on taxes on corporate income, as opposed to a floor? So does it become a race amongst countries to implement, the minimum tax, as opposed to perhaps maintain a higher statutory tax rate? And then the second question I have for you is, this has been mentioned by Anthony as well, this comment around redesign of incentives. So what do you think are the risks in terms of countries now finding other ways to incentivize investment? So perhaps it won't be tax incentives related to corporate income as such, but it might be taxes on, on employees, or VAT, for example, taxes that won't be included in the calculation of the effective tax rate. Do we start to see competition on those? So those are the two questions. Thank you.
Thanks for your questions. On the first one, I think that the 50% is like the whole planet will be tax haven. It's just above 12% of Ireland, and let's say that according to Sugman's calculation, the effective tax rate of Ireland is 5%. So there's a very difficult discussion about the statutory versus effective tax rates, and how to make a good point about the accounting of profits. That's a very difficult point. And why this has not been, even if historical decision, a controversy here in our region, is because the corporate, the CAT, the corporate income tax is the company income tax is something like 35% on average. And from that, there's a lot of exemptions, of course. So I think nobody is really concerned about this 15% rate global, except for some countries or some industries where there are special conditions. Maybe in Central America is different because they have a lot of exemptions, geographical exemptions. So that would be a concern. But here in South America, everybody has much higher taxes, statutory taxes. Concerning your second point, I would say that I forgot your second point. Sorry.
My second point was whether we start to see countries competing on other taxes, so not taxes on corporate income that go into the calculation of the global minimum tax, but other tax types.
Okay, it's very different from country to country. There's for instance, mine in Chile and Peru may compete for attracting investment with different mechanisms, also with the VAT, so of course there's a lot of other incentives, but with the present prices of copper, for instance, companies will not need incentives for the next years. I mean, there's of course a plan to, I don't know, 20 years with a high price of copper. There's a different question in Central America, for instance, where they produce mostly the same kind of manufacturing, and they have their own natural resources dotation. So there, the fiscal competition is very how can I say? Is seen as the main driver of development, or at least of growth. So there's a lot of work to do to convince officers and authorities that that is not the way to make a development or a growth that is mostly stabilizing or not destabilizing in the long term. So, because many of those countries have very low collection of taxes, maybe 18%, maybe 20%. So they have to do a very strong effort to collect more, and that would not be possible if you are considering tax exemption. So there, the dilemma, the trade-off between growth and tax collection is very difficult to maintain in the orientation of keeping good collection plans and good administrations in the tax side. So it's as you say, there's a lot there will be a lot of tax incentives or the temptation of tax incentives in the near future.
Thanks very much, Ricardo. It's interesting to hear that, you know, different countries, as you'd expect, have different experiences depending on their economies, what drives investment, what sectors are important. So thank you very much for your comments. Joy, over to you. So Joy is our the expert on the panel that's really working hard to bring together the investment and tax piece on a daily basis. So Joy, we're really looking to you, and we've had a number of questions in the chat on, you know, what's the impact on of this on the economy and productivity of countries, especially given COVID. What are your predictions on the impact of foreign direct investment as a result of amending tax incentives? And lastly, there was a question also about what are the legal issues for countries? And I think Tamar can speak to the issue of concession agreements, but it would be great to hear from you on any arbitration issues arising from bilateral investment disputes. So those are some of the questions in the chat, but I think the overall question to you is, what does all this mean for trade and investment in developing countries?
Okay,
Thanks, Joy.
I'll start with the last question that you raised, and I hope you can hear me well. And then, you know, we can go into the other issues. So it's important to have the understanding that investment promotion is not only dealt with in international investment agreements, it also features as part of free trade agreements as investment protocols, right? And as we begin to change the parameters of competition for investment from a tax perspective, it means that we have to have an understanding of how trade and investment parameters will need to respond, right, because of what's happening in the tax space. So I sat down and kind of thought about the question you were asking, because as Anthony has said, everything is kind of still up in the air. And for me, I thought, okay, what questions should we be asking and what trends should we begin to observe? And so there are a number of questions we should ask about how this will affect the behavior of countries that are concerned with using tax-based incentives as a tool to attract investment and to liberalize trade flows. And in as much as a lot of documentation, a lot of publications have come out saying, well, tax-based incentives are not very effective and you won't be very successful in that sense, we still have to acknowledge that countries still use tax-based incentives, right? And if they still do, what is the impact for those tax-based incentives? And I'm also going to address the question you asked, Ricardo, because I think it's really relevant about personal income taxes and VAT. So first, the impact is, of course, dependent on the enabling rules and the actions that more economically powerful countries will take, right? So first, you know, is it effective or is it nominal? I think the G7 haven't made that entirely clear. Are we talking, how do we calculate the tax base? And then will we be looking at sanctions if you refuse to implement in the way that is expected of you as a country? So, I mean, while it's in the best interest to introduce a floor to tax competition, countries are still using tax incentives. And let me kind of explain this, right? And in 2019, the African Ministers of Finance at their AU meeting, their annual meeting, they expressed the desire to continue to maintain tax-based incentives. And that desire is still evident. So for example, Kenya recently introduced an extensive exemption regime for Japanese investors in the country. Rwanda recently expanded their investment promotion regime, which includes a preferential rate of 0% on corporate income tax, and that's just in February 2021. What's also interesting though, is it also includes exemptions from VAT on funds transfers and zero rating for locally purchased goods and services, and exemptions from personal income tax for foreigners recruited by the relevant entity. So I think we're witnessing a little bit of a shift, right? There's a focus to other mobile factors of the economy, and we're looking at the really hot and emergent factors that have probably resulted because of COVID. So what we're also seeing alongside what I've mentioned with Rwanda is golden passport regimes are increasing, Cyprus being like forefront in that. Remote worker programs are increasing, and as you mentioned, VAT-based incentives are also increasing. So yes, countries are changing their focus from corporate income to other aspects of the economy or other aspects of taxation. So what does this tell us? Does a global minimum tax on corporate income mean that we're ending competition on the basis of taxation? Will all investment incentives need to be revised? At a minimum, it should change the behavior of multinationals, for starters. at the very least, perhaps they will be encouraged not to demand certain concessions from governments, but that's relating to corporate income in particular, right? But it's unlikely to reduce the focus on tax. And it should instigate a discussion. Ideally, if you ask me, we should be focusing on other factors like simplicity of the system or certainty or fairness, right? Those are much more tangible, but they also reduce the compliance burden for most companies that would make it much easier to invest. However, countries are still focused on trying to make their economies attractive to investment or for trade for whatever reason. And that means that new frontiers for tax competition are being explored and are being used to attract other aspects of investment. So I think a big thing we will need to ask ourselves is, should we then look into how competition overall affects taxation and the tax decisions that we're making? And then we need to then, reflect on the objectives of investment regimes that we introduce. So indeed, in our work at the Institute, we are certainly asking this question, and it's extremely important that investment policymakers and trade policymakers have the understanding that whatever is happening in the tax competitive space will impact their decisions in the trade and investment space. Just to add one last thing, I think this is an opportunity for regional cooperation, especially on the Africa level, Anthony. I think that as we go into the CFTA framework in Africa and we continue to negotiate the investment protocol, perhaps this is an opportunity for us to then look into what tax competition at a regional level should look like and how we can eliminate, the national competitive basis and look at regional and how Africa as a whole can benefit from this discussion by making it a regional one. Thank you.
Joy, can I ask you a follow-up question just on the
Sure.
issue of arbitration and the interaction with bilateral investment treaties? So where do you see that? I think we've had a number of questions with people that are concerned about, what does this mean in terms of disputes?
So that's a really great question, and I can't answer it with significant certainty, but I can say that, first of all, there are still existing risks that tax measures are covered by investment agreements as they stand at the moment. And these risks have materialized in the form of a number of arbitration cases through the investor-state dispute settlement process. And most recently, we've probably heard the most about Vodafone and CAN cases, and which are raised with reason, but indeed there is the risk of tax measures falling into other spaces and being regulated by other spaces. And this overlap that seems to be happening, this interaction should be a concern, not just for investors, but also for the tax space as well, which is why we need more discussion between the two communities. So, in the face of this minimum tax, what could potentially happen? I think in the Pillar 1 and 2 proposals, there's already the discussion about the potential for disputes. And if we remain unresolved in the tax space about disputes, of course, then investment will be the next option for most of the multinationals where possible, right? Because, you could introduce a number of carve-outs, but indeed where it falls beyond reason, there is a likelihood that, an arbitration case can be raised. So it's important for us to all be aware of the risks, but to also address the extent to which we can carve out or safeguard tax measures in this sense, especially in the face of these increasingly complex proposals that are coming out, and the increasing complexity is, of course, more disputes will arise. Yeah.
Thanks, Joy. Can I ask you one final question that's just come up in the chat? Is you just had a report recently on the interaction between bilateral investment treaties and taxation, in particular double tax treaties.
Yes.
And one of the questions from participants was, do you think double tax treaties or some elements of double tax treaties might become less relevant going forward? Because insofar as double tax treaties offer lower rates of tax, does that become irrelevant now with a global minimum tax, thinking, lower withholding tax rates on related party interest expense and so on?
There's a question that I actually have, and I'm really sorry if someone was knocking at my door. I'm sorry, it's the problem of working from home. This is a question I actually wanted to kind of discuss with Anthony as well, right? Is, are we talking about the 100 top multinationals, or are we talking about all multinationals in the world? And, beyond just the multinationals, there are large companies operating in developing countries as well that we need to address. The question of investment incentives and the use of investment incentives will mainly be determined by the rules that fall behind these decisions, right? So I wanted to also point out that, how we calculate the base is going to be very important, because there are different rules for calculating the base for corporate income. And if it remains different, it means that, whatever you do, it probably doesn't matter, because it's not quite comparable to say, in Kenya, you're paying 15%, but in the States, you're paying 10, whatever the case may be. So I think that we need to watch the space. We probably need to monitor how these rules will be determined. But I am probably concerned about how we would negotiate calculating that base. And I think African countries probably need to pay keen attention to this. This is probably where we'll see an increased, I don't want to say infringement, but I will use the word because I can't think of the other word, infringement on the sovereignty of countries to decide how to formulate that base. And I mean, what's interesting to me is what's happened in Europe. They've said, well, we possibly want to look at a consolidated corporate tax base, potentially. And potentially this might work out. I'm not quite sure how it would work out, but maybe that's where our regional discussions need to go on the African continent and perhaps even on the Asian continent, that let's have a regional agreement, because there are significant differences in the way that regions and countries operate that need to be acknowledged quite extensively, I think. So I'm enthusiastic. Maybe global discussions are quite interesting, but we need to acknowledge and address the context. Yeah.
Thanks very much, Joy. I'm seeing nods of agreement from Anthony. I'll come back at the end for any of the panelists to share any thoughts. I know a lot's been said, but I don't want to delay Thomas, inviting you to make your remarks. So Thomas is going to turn now to the question of implementation. So we've talked a lot about issues of design, what it means for incentives, what the impact is on investment. So the question for Thomas is, what are some of the challenges that developing countries are likely to face in the implementation of a global minimum tax? Thomas.
Thank you very much, Alia. Thanks for the other presenters to already bring forward so many interesting thoughts and perspectives. So I'm going to build on all of this and talk a bit about some of the implementation challenges. So, Joy just hinted about the different tax rules that different countries have, and that might have some impact on how their effective tax rate is calculated or how it impacts them. Anthony described also how different rules will work, and why for developing countries the likely outcome of the reform will probably not be a direct immediate benefit. Like they won't benefit directly from additional revenue through the rules that are proposed in the reform. They might benefit indirectly, as Anthony described, because there is less tax competition and the behavior of multinational companies change, and that way they reallocate more of their tax base to these countries. But the other way that developing countries can benefit is really take action and adapt their legal frameworks to the new reality of a global minimum tax and the possibility that other countries would now be able to tax any income that's not taxed at the minimum rate in their own jurisdiction. So that means, quite a bit of changes, honestly. So, for example, if you're a developing country and you've been given tax incentives for investors, because that's why you've been advised by the investor community and maybe other international organizations that have been promoting them for a long time. And Ricardo mentioned, since in the 80s, it was basically part of the package. Like if you wanted to attract foreign investment as a developing countries, you had to give tax incentives. So many developing countries have them in their legal frameworks. And so now if this global minimum tax, is enacted, they will have to remove them. So that means removing tax incentives, especially tax holidays, the sort of like the tax incentives that reduce tax space locally for a set period of time. They have to remove these taxes from general tax law, investment laws, sectoral laws like the mining laws, oil and gas laws, any kind of sectoral law that has tax incentives embedded. So that's quite a bit of legislative work, in each country. And as Joe mentioned, some of the incentives also also awarded through investment agreements. So that means these might need to be revised as well to be adapted. So that's quite a bit of work, and we need to probably start planning about what this means already. And Joy mentioned, I think Joy mentioned that some governments, as recently as earlier this year in Munanda, were still granting these types of incentives in their investment treaties. So that's why we organize this webinar. So we wanted to start spreading the word that this type of incentives are not going to work long term, and so they should be removed as soon as possible from any existing laws, legislation, or treaties. There is a potential alternative that might be easier for some countries to implement, is to create a domestic minimum tax that mirrors the way the global minimum tax will be defined. So that way, that if once that domestic minimum tax is implemented, every country will be able to capture at least the minimum level of tax that would otherwise be transferred to another jurisdiction. So that may be the shortcut for some countries that are not able to change all of their laws that contain tax incentives. That's not the end of the problem. As some people mentioned in the chat, there is another layer of difficulty, is that many countries have not only tax incentives, not only in laws, but also in contracts, mining contracts, oil and gas contracts, other types of concession agreements. And these contracts often have a form of stabilization in them, a provision that prevents the government from changing the terms of the contracts unilaterally. And this also applies to investment treaties, as Joy noted. Some of these treaties include provisions that are interpreted by arbitration tribunals as, in effect, a stabilization provision. And so for countries that would now be potentially subject to the global minimum tax, and that would want to remove or change the tax incentives that they've already given to foreign investors, they might be prevented from doing so by the stabilization provision. And that's where a lot more global cooperation is needed. Because if these countries try to change the contracts themselves and companies take them to arbitration, they might incur large costs in arbitration and might end up losing. In practice, a lot of arbitration courts have interpreted stabilization provision in a very strict way. And so that's also something we want to call the attention of everyone to. It's important that at this stage, there are discussions next week. It's important that at least within the inclusive framework, there is an acknowledgement that it should be the right of countries that have granted contracts or that have awarded stabilization of fiscal terms to foreign investors, and that include tax incentives, to change those tax incentives to respond to the global minimum tax. They should have some form of exemption from the typical or flexibility around the interpretation of a stabilization provision for that purpose, especially. But for this, they need some form of global statements, global support from the inclusive framework, and that message needs also to be given to investors themselves and to arbitration tribunals. We also hope that multinational companies themselves will be understanding, because in effect, if they don't agree to change the tax incentives that benefit from in stabilized agreements, they will be paying taxes anyway on that income in their headquarter jurisdiction. So we can expect some form of understanding, but it needs to be pretty clear from the outset that this is going to happen. And if it's anticipated, it's less likely to lead to disputes further down the line. I'll just stop here, Ali, because I want to make sure we have time for questions.
Thanks very much, Thomas. That's great. And yeah, I think there's been many questions in the chat about precisely this issue of what are the legal barriers to making these changes. And certainly there are many when it comes to changing concession agreements, and certainly treaties as well, as has been mentioned already. One question to you, I think, is around a question that we received earlier about deductions against taxes payable. So you mentioned this issue of, well, it's going to be, and I think Joy's mentioned this as well, about how you determine the base in different countries. If you have different tax rules, how does that reconcile with the accounting profits? So maybe you can speak a little bit about that, and what are some of the challenges there that need to be resolved in the design of the rule?
Thanks, Ali. So also, I hope everyone can follow this. This can go into a little bit of detail. If you don't get everything now, we have actually a brief, like a report we wrote with ATAF a couple of months ago that goes into this in more detail. So we can share it. So if you want to dive into this problem, but so that's exactly the problem. We have different countries in the world with different tax rules. And for the purpose of implementing a global minimum tax, there needs to be some form of comparable way of assessing the tax base. And so the solution proposed in Pillar 2 now, in the global tax reform proposals, is to use to calculate the effective tax rate based on what Ali mentioned as accounting profits. So using the accounting rules that the parent company uses to declare its financial statements. So the most, some of the most globally known are the IFRS or the GAAP rules in the US. There are also standards at the regional level. There is one for that country in West Africa. But using the standards used by the parent company would ensure, and so at least harmonization at the level of each multinational company. But that means that there will be differences in the effective tax rate calculated based on that accounting profit and the effective tax rate that you would calculate at the level of each jurisdiction. So that's just a complication in the proposal. It shouldn't be in most cases, it shouldn't be so much of an issue, except when there are substantial differences in the tax bases, and that's particularly the case for industries where you have a large investment in capital expenditure that takes a long time to be recovered, which is the case in the mining sector in particular, which is why we wrote about it before. So in those sectors, typically the level of depreciation in the first few years of a project is particularly large, according to, especially when domestic tax rules allow some form of accelerated depreciation. And that's create a substantial difference between the tax base, taxable income at the country level, which tends to be very limited in the first few years of a project, and that same income calculated in financial statements of company at the global level, because the depreciation rules tend to be much longer in terms of how long the asset is depreciated. And so there's a risk that the minimum tax is actually falls on those cases where there isn't actually untaxed profit generated. It's just that there is limited profit because you were in a cost recovery period. And actually most of the profit will be generated later on in the stage of a project. So that's called timing difference between domestic tax rules and accounting profits. And that difference, there are different proposals being discussed. Anthony is in the weeds, he can probably tell us more about it. There are different proposals that are being discussed currently at the level of the inclusive framework to address this issue. So I'm not going into detail now, but we expect these issues to be resolved. And it's important because we've been talking about tax incentives today as if it's just one big category of tax incentives and they're all mostly bad. Actually, it's a bit more nuanced. For sure, there are many tax incentives that are very detrimental and not efficient at attractive investments, in particular tax breaks, the types of incentives that cut down the level of tax for a set period of time and really deprive countries from income tax. But there are other types of tax incentives whose effect is just to postpone taxes to later in the life of a company or a project. So these types of what we call them cost-based incentives, usually these types are not as detrimental to developing countries' domestic revenue mobilization. And so we expect them to be still available within the toolkits of developing countries, but that problem of timing difference has to be resolved in the details of the rules first.
Thanks very much, Tom.
Sorry for the technical digression.
No, it's very clear. And for those that would like to read up, we published a piece with ATAF on this not long ago. So in the last 5 minutes, I have one further question for each of you. However, I would appreciate it if you could please keep your answer to no more than 1 minute. So just a very quick response. So Anthony, let me start with you. This question is about the subject to tax rule. Saying the comment is the subject to tax rule could provide large benefits to developing countries, but requires changes to bilateral treaties. Is this going to be difficult for developing countries to do? In 1 minute.
Okay. First and foremost, I think it's a good question, and subject to tax indeed is beneficial for developing countries because of a range of issues I explained about many treaties having very many weaknesses, such as very low tax rates. So having a mechanism which goes beyond the treaty and gives you the right to tax back, it's beneficial. So a mechanism of implementing this is critical. If it's bilateral, it's gonna be difficult because you have a chance of maybe developed countries who don't favor subject to tax say, no, we don't want to negotiate our treaty. And therefore, I think within the inclusive framework, an alternative mechanism of having this negotiated perhaps in a multilateral instrument, which is mandatory under certain circumstances, perhaps that will be a better outcome, which helps developing countries to get the benefits of subject to tax because they're much easier to negotiate. Yeah.
Perfect. Thank you very much, Anthony. Great. Joy, a quick question for you. Do you think, and sort of related to investment benefits, do you think this minimum tax is going to impact the workforce in any given country? For example, if a company wants to cut down its costs, they normally start dismissing their employees. What are your thoughts?
That's an interesting question. And I guess it's a question that kind of contrasts with the fact that remote worker programs and generally exemptions on personal income tax are happening more and more. So I don't know if there's going to be, a balance in the way that countries are now offering incentives that will replace what was once, the expenditure under the corporate income tax incentive base is now shifting over. So I mean, that's a really interesting question, but I'm not sure how to respond to it because we need to probably monitor the impact that newer incentive frontiers will have on how much savings companies can make and whether it will then translate into, reducing the workforce as well. But again, of course, the multinationals that we are targeting are multinationals that have made significant profit, especially in the COVID period as well. So, we should probably acknowledge that factor as well.
Thanks very much, Joy. Thomas, a quick question to you, and then one final one to Ricardo. So, Thomas, people want more details on the domestic minimum tax you mentioned. So can you say in 60 seconds a little bit more about what that would look like and why it might be beneficial?
Thanks, Eddie. So there are a lot of existing domestic minimum tax on corporate income, but typically these are based on a turnover. And if there's no income declared, then at least the minimum tax on turnover applies. And this can be seen as a backstop to ensure a minimum level of taxation. And a recent IMF study actually found out that in many cases, this had a positive effect on total tax collection and it was able to limit tax avoidance. That's one option. The other option is to wait until the final details of Pillar 2 of the global tax reform on the minimum tax are published and enacted. And then countries can simply mirror the technical details of how the minimum tax is calculated, especially the income inclusion rule, and have a sort of a domestic version so that instead of another jurisdiction collecting the untaxed or undertaxed income in the source country, the source country itself has a special rule that collects exactly the amount of tax that might be collected by the residence country under the income inclusion rule. There's a paper published by an academic, which I can put in the chat in a second.
Thanks, Thomas. I posted the IMF study. Thank you.
Thank you.
Ricardo, the last question to you. It's an interesting question to finish on. Is there an opportunity for legal action to be taken against companies, multinational companies that don't comply with this rule? What do you think about that?
Well, well, I'm not an expert in international laws, but it's a very long way. This is not just a question of deciding the global minimum tax. There will be a lot of contracts to review, a lot of probably access to international. I don't know. There's no bodies for the moment, and one way to, of course, to introduce a more fair order, international order, would be to involve the United Nations in all these in all these trade questions, like, I don't know, the World Trade Organization, something like that, concerning the the international tax conflict. So that would be my proposal. One thing that I forgot to observe is the question of the political economy of tax incentives. There's a lot of within countries. There's a lot of controversy, and while the finance minister wants to dismantle, the trade minister wants to open more to fiscal for investments. So there's a question here within countries very important. I remember some time in the Dominican Republic where one of the tax reforms included the dismantlement of taxation of incentives in tourism, but of course, and there were no within the executive that was what was dismantled was the intention to dismantle, So it's a very difficult issue even within countries.
Thanks very much, Ricardo. And it's unfortunate that we often come to the political economy questions at the end of these things. We should really start the conversation with that, because that's critical. And I think it brings us back to the point that Nathalie made at the start, which is why we're trying to bring together the investment and tax communities as part of this conversation, because as you said, often they have very different interests. One is to attract investment, perhaps provide incentives to bring in tourism, and the Revenue Authority and the Finance Ministry to collect taxes. So often, we're dealing with conflict between government agencies, or different views between government agencies, let alone trying to reach global agreement on these sorts of issues. So we'll finish there because we're already over time, but thank you so much to my panelists today, to Thomas, Ricardo, Joy, and Anthony. We appreciate you making the time and sharing your insights. There's lots to discuss, and we could talk at length on this topic, but certainly for participants that have joined us, please stay tuned. Next week is a big week. The G20 and Inclusive Framework will meet, and so you'll be sure to see more in the media around what's agreed there, and whether the G7's proposal of 15% is accepted. So please look out for that next week. We at IISD and IGF will continue to provide analysis on these issues. So do have a look at our website for more information there. So thank you very much, everyone.